introduction. This is the monthly report on oil and natural gas price forecasts. We're looking at West Texas and Canadian Western Canada Select for oil, and then of course Henry Hub and AECO for gas pricing. I guess a few salient points here. We saw COVID impact, of course, all commodity pricing in 2020. That led to a falling capex and rig count. Of course, we saw LNG exports fall off, as well as foreign markets took less gas as well. And since we saw a rebound in LNG exports in 2020, and of course we've seen rig counts slow to recover. So we've headed into this high price era for Henry Hub. Colder than normal winter didn't help as well. We're seeing a rebound in rig count currently. So we'd expect kind of heading into this 2023 as we get supply kind of meeting up with this kind of increased demand for LNG, increased demand for weather. So that storage market that we've seen this summer kind of normalize over 2022. We expect Henry Hub pricing to trend lower in 2023. There is this potential for increased market volatility as Asian and European natural gas markets pull more on North American LNG exports going forward throughout the forecast. Potential for North American storage to be used for these foreign markets as they have colder than normal or warmer than normal demand impacts from the natural gas markets, and that'll filter down to Henry Hub as we've seen kind of in the 2020 market as well. I guess going to our forecast methodology for natural gas pricing, lower cost supply is generally developed and produced first. High cost supplies are sequenced in, of course. I guess a couple of points on that would be something like Montney, where we have a limited ability to take that low cost Montney supply and push that into the North American market. We have fairly full pipelines currently, so even though Montney supply is quite competitive, it can't get to that market. This is similar to Permian, I guess. Gas-focused supplies are fairly cheap, but unfortunately, associated gas from the Permian Basin is even cheaper. Really, it's almost a nuisance product from oil production. So that can't be tapped and brought to market due to infrastructure constraints. Generally, lower price is produced first, lower cost is produced first and sequenced in. And of course, a more detailed view of this natural gas cost curve will be produced for the August topic paper from Incorrys, and we'll go on a basin by basin supply costs there. This is developed with well IPs, and that gives us a sense of hot spots in the basins and where the highest EURs are, estimated ultimate resources. And of course, we look at the composition of various plays as well, how much upside there is from liquids rich gas versus drier gas as well. We use this to build out mapping, and gives us well density assumptions to provide that inventory at various cost levels as well. And the end result is this cost curve where we see kind of the next 200 BCF of resource available at that $1.50 type or less range, Again, some of this can't be tapped due to infrastructure constraints. So you have to go to that next kind of $1.50 to $2 level on a go-forward basis. When we look at the fundamentals, how they're playing out over the next decade, we come up with this chart. We kind of swinging the pendulum, demand or drops in supply act as a upward price driver. And of course, drops in demand or increases in natural gas supply act as a downward price driver, all things being equal. So as we see, the biggest impacts on the next decade or so are gas-fired generation, growth of 11 or so BCF a day. That's offset slightly by associated gas, continued growth from associated basins like the Permian, the Bakken, Eagle Ford a little bit. LNG exports, big growth there, almost 8 BCF a day over the next decade, a little less than half coming from the west coast of Canada. And of course, that draws on the WCSB to meet that kind of LNG export growth. Also meeting that growth is the Haynesville, up 3.5 BCF a day in that next decade there as well. Marcellus, Utica, growing a little less than it has in the last decade, kind of meeting that infrastructure constraints, and growth is somewhat muted and follows northeast demand, intra-region demand, and less inter-region demand for the Marcellus Utica area. This gives us this kind of a range of 280 to 385 nominal pricing for Henry Hub over the next decade as well. That's where we see it on a nominal basis. Real basis, I guess we're into a high of around 3.25 or so real pricing over the next 10 years. As I said, top influences, of course, are the gas-fired and LNG exports, and really it's offset by that huge low-cost resource that we showed in the cost curve on the previous slide. Looking at the fundamentals, natural gas demand drivers, of course, LNG, biggest push there, as we see in the chart, this blue wedge coming out of nowhere and ending up almost 20 BCF a day by 2030. Also, the coal to gas-fired switch in the lower 48. Much of that has occurred in Canada. Likely be almost no coal-fired generation in Canada by 2030. U.S. is on that path, probably a little longer than the next decade, though. Overall, power emissions in the U.S. as this switch occurs go 42% below 2005 levels, so kind of meeting this low carbon future. And not showed material in the chart, but we see a big increase in gas-fired or electric vehicles, and that's going to drive overall power generation requirements over the next decade as well. Offsetting that, of course, is the North American gas supply picture here. As we see, Western Canada, strong growth over the next decade. That's to meet the LNG exports off the west coast of Canada. This change of Appalachian-associated gas in the North American production mix, kind of reaching that 55% of total production by 2030. Permian, of course, makes up a huge amount of that. And of course, Appalachia has moved from this high growth over the last decade to more of a maintaining as we go forward here. Haynesville, another big growth area, and of course the expensive U.S. Midcon declining slowly over the next 10 years as well. Yeah, as I talked about earlier, really this LNG impacting Henry Hub more and more. This volatility being imported into the North American gas market. This chart basically shows the Henry Hub price. It looks like it's supposed to be blue. There must have been a uh, error in the copy and paste process. But the green line is Henry Hub on this chart, and then the European TTF market is the orange line. I've basically taken from that orange line the 15% of Henry Hub as a variable cost. That's what the contracts for liquefaction call for. And then also variable is that maritime shipping and the regas on the European end of things as well. Below that is the $3 liquefaction toll. Some of it, some tolls are contracts are for a little less than that, but most of them are at that $3 level in gray. And you really see here what drove a lot of these business development decisions on building the liquefiers on North America. That huge arbitrage opportunity that we saw in the beginning of the last decade. In 2016, Sabine Pass started up, and we started to export in that era, which have grown to almost well over 10 BCF a day on a monthly basis now. We saw tight spreads where really shippers were not recovering their costs, their sunk cost, but the variable costs were able to be recovered. So shipments went out. You saw that arbitrage open up heading toward 2019. And then in 2020, as we talked about, COVID hit, and really there was no money to be made by shipping LNG out of the North American market, and we saw LNG exports fall to that 2-3 BCF level since recovering, and now recently that arbitrage has opened up with the full recovery here. We see as we grow further, LNG exports grow further, we'll expect swings in overseas markets to impact pricing at Henry Hub. So as European prices scream up, they'll call on Henry Hub for gas supplies. That'll impact storage levels. That'll impact North American basis as well. So this international markets will become more and more important on a go-forward basis. We've tried to account for some of this in our algorithm to capture that volatility, that storage and marketing costs that are included in the natural gas pricing in North America. But we'll have to watch and make sure our models are truly representing foreign markets on a go-forward basis here. But this is becoming more and more important in Henry Hub price formation in North America. Going to Henry Hub price forecast, show on the charts the monthly price on the line, and the yearly average in the bars. As we see, 2021, big increase as a colder than normal winter left us with a bit of a storage deficit. We expect a bit of a reset as we hit November and go into the 2021-2022 winter. We'll see storage spreads normalize again as we hit a forecast for a more normalized winter going throughout the forecast. On a normalized winter basis, we see 2022 kind of a return to a more balanced market. more of a 280 Henry Hub pricing level. And then, as I said, moving up toward a nominal 388, which equates to about a 225 or 325 real pricing in 2030. When we look at AECO, we've seen AECO basis narrow substantially, as we've said in the past. We believe that this would happen in this 2020-2021 time period, as the Trans-Canada Mainline toll situation has been solved, has some pipeline constraints within the NGTL system has been resolved. We've seen this narrowing of AECO basis. We see a AECO basis in that 65 cent on a go forward basis as a more normal situation. And going forward, we see LNG startup off the west coast basically holding basis firm with carbon cost being brought into the forecast during the period. The increase in carbon costs going from 40.50 in the 2021-22 per ton to $170 a ton by 2030. That'll be a factor in widening basis, as EcoNit producers will have to eat that in the integrated North American market. So we'll see a widening of basis driver as that carbon pricing in Western Canada. Potential for the U.S. to start to factor in a carbon price could offset some of that, but as of yet, it's tough to see that happening in the next decade. There likely to be state challenges to any attempt to do a widespread carbon pricing scheme in the lower 48, I think. On oil side of things, or on assumption side of things, normalized weather. We see core sectors, residential, commercial, fairly price inelastic. They're more impacted by heating degree days. Electric power generation is influenced more by gross domestic product growth. However, the ability of natural gas to follow loads is makes natural gas fired sector of that power supply a little less impacted by gross domestic product. Industrial demand is certainly elastic, correlated to natural gas pricing. At lower price levels, we see industrial growing slightly, as it has over the last 5 or 6 years. Inflation and GDP, we see inflation at that 2.2% inflation rate. We see the Canada has a target, and of course the Federal Reserve has a I guess a more implicit target, and of course the Federal Reserve minutes have projected this kind of 1.9 to 2.5% long run inflation over the last half dozen years or so. So we're using the 2.2% inflation level to escalate our 2021 dollars. GDP, we've seen this kind of average rate of 2.3% over the past decade or so in the US, and 2.2% in Canada. We've assumed for our modeling purposes a rate of 2.2% per year real GDP growth throughout North America. Looking at oil, we've done a similar full cycle look at shale plays across North America. These include the Permian, Bakken, Eagle Ford. We're seeing about 64 billion barrels of this unconventional shale at a full cycle cost of less than $55 a barrel. Our view is that long-term prices in excess of this 55 real 2020 dollars will spur drilling and lead to production growth. Of course, what we've seen in a COVID world is producers faced with this drop in commodity pricing, take on that extra debt. So we're seeing producers look to repair balance sheets, focused on paying back debt, less reinvestment to grow production near term. So we see over the next couple of years this focus on more balanced sheet for producers, more money going to the banks rather than going to induce supply response to these higher oil pricing. Of course, when post 2022, as these producers kind of look to take some of this extra cash flow and put it into growing production, it might take a little time to come to a fruition, as development requires pipeline infrastructure, utilities, gas plants, water handling. So there could be a further leg post 2022 as producers look to take a more balanced approach than we saw in the last decade in terms of growth of production, but still growing production indeed. That leads us to this $62 type range for WTI in 2022. About that in 2023, and then out to $65 in 2030 on a nominal basis. On a real basis, that 2030 is around $55, $56 a barrel. So we see kind of this full cycle cost trend balancing the market as we see more production come on to kind of balance supply demand fundamentals worldwide. Looking at Western Canada Select basis, we see kind of this recovery in oil sands production, and of course we're seeing Line 3 likely coming into service in the next I guess couple of months, and then fully in Q4 we'll see that last leg in Minnesota tested and flowing oil. We expect Trans Mountain in service late in 2022, and of course that will divert rail volumes, and of course take away from Enbridge Midwest flows in the near term, and then longer term that'll fill up with the growth barrels from the oil sands. That leads us to Western Canada Select basis in the $14 range in 2022, and then narrowing throughout the forecast period as the transportation bottlenecks that we've seen over the last 5-6 years have been basically solved by the 700 or so thousand barrels on Trans Mountain, and the 500,000 or so barrels on the Line 3 here. Rail no longer required, and that leads to this narrowing basis and WCS closing with WTI pricing.